Many people invest in debt instruments besides the share market. If you too are looking to invest in bond market, then there are few things that you should keep in mind. In this Money Gyan, we are going to tell you just that. Investing in bond basically means that you are giving loan to a government or a company. In return, you also get interest on a regular basis. At maturity, your principal amount is returned. There is also a secondary market for bonds. Now let's look at these things that you have to keep in mind while investing in bonds. First of all, you have to see whether the bonds are secured or not. Secured bond indicates whether the party issuing the bonds has some asset as collateral or not. There is no such collateral in unsecured bonds. Second, you need to look at the maturity of the bond. Maturity is the date when the bond issuer returns the principal amount. Maturity of 1 to 5 years is considered as short term, 5 to 12 years as medium term, and more than 12 years as long term. You can choose maturity on the basis of your financial goals. Then comes the coupon rate. Coupon rate is that specific interest rate which is given to bond holders at a regular interval. Generally, you get 8 to 12% return on bonds in India. This is way higher than FD. Next comes the tax factor. Generally, the earnings from bonds are taxed. However, some bonds are also tax-free. For example, there is no tax on earnings from green bond. You should calculate your return after paying the tax. And finally, the most important point to consider is bond rating. Rating basically tells you how reliable a bond is. For government bonds, there is the backing of the government. However, in the case of corporate bonds, you should definitely view such ratings. It's better to invest in bonds with higher ratings like AAA.